Frequency Podcast Network. Stories that matter, podcasts that resonate.
In this economy, it's complicated and distorted. The U.S. just had its worst first quarter in 3 years, looking at a contraction rate of 0.3%, led by the largest spike on record for American companies importing goods, up 41% and a record-breaking trade deficit as a result, as American companies were front-loading their purchases, trying to get ahead of tariffs. Here at home, the February GDP report in this past week from StatsCan showed some shrink for our economy, contracting by 0.2% for the month, which appeared to be a combination of worries about the start of the tariffs and trade, which were at least briefly in place at the start of February, but also some really bad winter weather. Consumers, well, they're pretty much stuck in the middle, wondering what's coming next from the Oval Office and the effects that's having on the labor market, real estate, and interest rates. The trade war has basically led to a loss of economic momentum. In its economic outlook released this week by Deloitte Canada, the forecast points to an uncertain future for Canadian export-oriented industries, think steel and autos. It's taking a toll on business and consumer confidence, which Deloitte says will weigh on investment, hiring, and spending decisions. Net result? A struggling economy. My name is Mike Eppel, and this is the In This Economy podcast. Joining me today to talk about the Deloitte study is Don Desjardins, the chief economist at Deloitte Canada. Thanks for joining us, Don. Don, these numbers that we got in this week were really the first true indicators or evidence that anticipation and actually the start of a trade war hit the economy in the first quarter, and it's likely to get even more pronounced over the coming months. It's really a cloud that's hanging over pretty much everything right now, isn't it?
The uncertainty impact is evident in now the hard data, but it was for some time been evident in the soft data. And by that, I mean surveys, whether it's in the U.S., their purchasing manager survey or their consumer confidence survey, all of these surveys telling that, in fact, both businesses and consumers are worried. And those are echoed in the Canadian surveys as well.
Well, the fact that American companies were basically doing the right strategy, front-loading their purchases, record-breaking import numbers, and a record trade deficit in Q1 for the U.S. Imports were up 41%. I mean, that tells you everything you need to know about what they saw coming with the onset of tariffs and trying to get ahead of that.
Absolutely. I think you might have the decimal point in the wrong place, but yeah. 41% was the number. It's shocking, but it's as you said and as you'd expect. I mean, uncertainty makes businesses be active when they can be to be able to get ahead of something that's going to increase their costs. They know this, and so let's get it in quickly. And so we are definitely seeing that in the U.S. data.
So that basically leads us into your forecast for the year. The thesis being that there has been a stall in momentum. And, I guess if we go back to the start of 2025, we knew things would be uncertain, but I guess we didn't know it would be to this extent, right?
Yeah, we certainly, I think back to when we were running our numbers, and this was like late in 2024, for a report coming out in early January. And at that point, it was like, yeah, we're going to have some slowing, maybe not as much investment as we previously thought because of this uncertainty, but rates were lower, inflation was lower. We thought, okay, we're probably going to have an okay year for growth. But this has really been turned on its head recently, where we have seen such significant increases in uncertainty that we do now expect the economy to really not grow, let's put it that way, maybe contract for some period of time. Probably not, we're not calling for a long, dark, deep recession where you do think it's going to be a really sluggish, slow growth period for Canada's economy. It really does reflect the fact that this uncertainty has taken hold, and it has led both consumers and businesses really to take a giant step back and try and assess, well, where are we and what can we expect going forward? The rate story is still positive, but all of this uncertainty is giving a lot of consumers worries about their jobs, their job security, worried about their financial health because of all of the volatility in financial markets. So we definitely are seeing this in real time now. We are seeing the impact of this uncertainty.
And then you have all of the companies, many of the companies that have reported earnings in the first quarter, they've pulled their guidance. And that, is a tell right there that they're saying, we don't know. And that's not to be surprising. They can't make a solid expectation on anything at this point, especially, the auto sector is front and center.
Absolutely. And I think what's telling is the central bank. They have been lowering the policy rate. They stopped in April, citing the uncertainty and saying, okay, we'll take a pause here. But what's also telling is they, too, in terms of forecasting, provided scenarios rather than a banging the table forecast for the economy. So we're all in the same boat. We're all trying to determine how can the economy behave? How will the economy behave? And what are the central supports we can expect as we move forward? And at this stage, it's still uncertain.
What would be the hardest hit sectors in your estimation?
We have steel and aluminum, manufacturing. Those sectors are going to be hurt. Now, I say this at this particular moment. Anything can change, as we know. So I'm putting a timestamp on this. But, we are expecting these sectors because when we look at other goods that we send to the U.S., as long as they're compliant with the trade agreement, they are continuing to be tariff-free. Now, the data suggests that at the end of 2024, that was about 40% of goods traveling. Now, up to 90% by many accounting, it could be compliant. So we'll see an increase, I think, in companies making their goods PRISMA compliant in order to avoid the tariffs. So some will do better than others, but I think areas that we do see that are excluded from that agreement, we're going to see those areas of our economy really suffer.
Are you in the camp of the economy slipping into a recession this year?
We have two modest declines on back-to-back quarters. Given how uncertain it is out there, it does seem like you could have a decline, modest increase, and another decline. Recession, I would at this stage just called a marked slowing in economic activity, but if you take it literally as two back-to-back quarters of GDP contraction, then we have that in our current outlook.
Okay, so let's turn the focus a little bit to how we deal with this. We have a new government just coming off an election, a minority government nonetheless, but huge challenges for Prime Minister Mark Carney and crew. And then the Bank of Canada will be in the mix. We have to wait several weeks until the next Bank of Canada policy announcement. But we could actually see more activity from a federal government standpoint for policy in the short term. I would expect them to get working on this file pretty quick.
Yeah, I think so. I mean, I think what we should anticipate in the near term is supports for industries that are under extreme duress because of the tariffs, support for workers who are either furloughed or, in fact, lose their job because the economy is weakening. And over time, I mean, it is offering, I think, the opportunity to address some of these really long-standing issues for our economy. We're hearing a lot more about the willingness to hopefully eliminate, but at least reduce interprovincial trade barriers. We're hearing a lot more talk about can this infrastructure look like? How can we change the pattern from, north to south, from east to west? Like, how do we make our economy more efficient? And so whether that means building infrastructure to get our exports to other markets. Now, this isn't to say any of this is a quick fix or an easy fix, but it certainly, I think, has elevated those conversations and makes us more optimistic that once we finally get through this very rough patch, we may be actually in a better situation in terms of economic growth, economic productivity.
Well, you could argue we've never been really faced with the must-do on these issues, because it's like, yeah, we talk about improving productivity and investment and diversification and, interprovincial trade. And there's been a lot of discussion about it, but never okay, now it's time to do something about it. But again, there are challenges with that. Specifically, I'm thinking about the productivity issue. Businesses, need to invest, but are they going to want to invest again with the overhang of a trade dispute?
Absolutely. And it is really, we are going to have to look to different areas in the economy to really increase our productivity. And you're right, in the near term, that's probably not something you're going to be able to incent in any great manner. But having said that, we will emerge from this period, I'm knocking wood here, of uncertainty. We hopefully will get just even knowing what our trading relationship with the U.S. is going to look like, I think will be an encouragement to Canadian companies to look at different options and what does that look like in terms of building my business? Do I think about sending to other provinces? Do I think about actually connecting with other countries and expanding that way? So it will take time. Again, it's not a quick fix by any means, but I do think that this is kind of the moment. And we're hearing it everywhere. We're hearing it from clients. We're hearing it even all over. People are talking about this crisis for Canada and how can we actually emerge stronger. And I think that gives the political will to actually do it this time.
And also this talk about different trade deals with trade partners who may have not been traditional, considering we've always had this partnership with the United States. That's been sort of the easy route. Now we have to look overseas. China is sending out signals. I don't know if it's the enemy of our enemy as our friend at this point, but nevertheless, the global trade routes could be very much looking very different over the next little while.
Yeah, and Canada does have free trade agreements, I think, with 15 different areas. So it's not like we don't have the agreements. We've just never really had to tap and lean on them the way we will going forward.
And in the past, in crises, we've kind of relied on the Bank of Canada to help things out. But they're faced with this rare circumstance where the economy might be slowing, but inflation might also be climbing, and they're really going to be up against a wall. There's discussion that they're going to cut interest rates again next month, but how aggressive can they be? And at the end of the day, will that help as much as it maybe would have in the past?
Exactly. And they already have been, I would say, pretty aggressive. You've seen them move that rate from 5 to 2 3/4 in successive moves, only pausing in April. Possibly they will go again. I think they are wanting to provide any relief they can. But as you've stated, when we look at what's happening out there, it's a slower growth and inflation expectations are picking up. So how do you thread that needle? I think it's you can continue to lower rates, but I wouldn't say that they're going to go as an emergency. Like, let's just really get that rate down to the lowest level. That would raise concerns on the inflation front. So I think they will be really tactical and perhaps lower it a little bit more, but I wouldn't anticipate going back to those emergency type levels we've seen.
Dawn Desjardins, thank you very much for joining me today.
My pleasure.
That was Dawn Desjardins, the chief economist at Deloitte Canada. My name is Mike Eppel. You can send us feedback on this episode or story ideas to my email at mike.eppel@rci.rogers.com. On X, I'm at Eppman, EPPMAN. You can also leave a voicemail at 416-935-5935. You can find us on the Seeker app. And remember, please rate, review, follow, and share. Thanks for listening.